The National Association of Realtors just shocked the real estate world with a bold prediction. Home sales could surge 14% in 2026. That's 2 to 3 times the normal annual growth rate. After 3 years of the lowest transaction volumes in 30 years, are we really about to see a massive rebound? I'm a California realtor, and when I saw this forecast, my immediate thought was, that might be true for Texas and Florida, but what about California? Because here's what most national predictions miss: California operates under completely different rules. California's own housing association, C.A.R, predicts something far more modest, only 2% sales growth and 3.6% price increase to $905,000. That's a huge difference from N.A.R.'s 14%. So today, I'm not just repeating what you've heard everywhere else. I'm fact-checking these predictions, breaking down what is specifically happening in California, and showing you the 3 markets I'm personally watching versus the 2 I'm telling clients to avoid. But first, let me address something going viral on social media. People claim first-time buyers are now 40 years old on average. According to N.A.R.'s actual 2024 data, it's 35 to 36 years old, still historically high compared to the traditional 31 to 33, but not 40. These details matter because misinformation creates panic. Here's what all the major institutions agree on for 2026. Mortgage rates will drop to around 6%, prices will rise modestly 2 to 4%, and the real issue isn't interest rates, it's supply shortage. America has a housing deficit of 3 to 4.5 million units, a problem that's been building since the 2008 financial crisis. Let me walk you through what the major forecasters are actually saying, then show you why California's story is different. N.A.R.'s prediction: 14% sales jump, 4% price growth, rates at 6%. Their reasoning: rates dropping, strong employment, supply shortage, and improving buyer confidence. But here's the issue: N.A.R. is an industry association. Their mission is to keep the real estate industry running, so they're structurally optimistic. That doesn't mean they're wrong, just that they lean positive. Goldman Sachs, they're betting big on population migration states: Texas, Florida, Georgia, the Carolinas. They see fiscal stimulus continuing, wealthy buyers with cash, housing supply gaps, and institutional investors buying rental properties aggressively. Notice what's missing. California isn't on their hot list. Zillow, much more conservative. They predict only 4.3% sales increase and just 1.2% price growth. Zillow's key insight: demand exists, but people simply can't afford to buy. The market isn't limited by lack of buyers, it's limited by purchasing power. Fannie Mae and Freddie Mac, predicting 2.1% price growth, rates at 5.9%. They focus on affordability from a lending perspective. What can average households actually afford each month? CoreLogic says 2.5% growth nationally, but warns of massive regional differences. Some cities up, some down. MBA, Mortgage Bankers Association, the only institution predicting prices could actually drop slightly, by 0.3%. Now here's California's reality. C.A.R predicts California's median home price will hit a record $905,000 in 2026, up just 3.6% from $873,900 in 2025. Home sales will increase only 2%, that's 274,400 units compared to 269,000 in 2025. This is nowhere near N.A.R.'s optimistic 14%. Housing affordability in California will edge up to 18% in 2026, meaning only 18% of households can afford a median-priced home. That's up from 16% in 2024, but still historically terrible. 3 reasons. First, California faces unique challenges like the ongoing home insurance crisis and potential trade tensions. Second, California isn't experiencing the population inflow driving Texas and Florida. Third, California's high baseline prices mean even small percentage increases represent huge dollar amounts. Now let's talk about the supply crisis everyone keeps mentioning. The US has a 3 to 4.5 million unit shortage. C.A.R estimates it could be as high as 5 million. This isn't a new problem. This debt started accumulating after the 2008 financial crisis. After 2008, builders were traumatized. For nearly a decade, they barely built anything. Permits were slow, construction costs skyrocketed, labor shortages hit hard. By the time builders recovered confidence, we were already millions of units behind demand. But here's what confuses people. Wait, I see houses sitting on the market. Builders are offering incentives. How is there a shortage? Here's the truth. America doesn't lack houses. It lacks affordable houses that regular people can buy. Builders won't construct entry-level homes anymore. Why? Profit margins are too thin. They'd rather build luxury homes, vacation properties, or build-to-rent communities for institutional investors. These projects have higher margins and faster returns. The homes that first-time buyers need simply aren't being built in sufficient numbers. Meanwhile, here's the lock-in effect that's strangling inventory. About 90% of homeowners have mortgage rates below 5%, and over 60% have rates below 4%. These people are financially locked in. If they sell and buy another home at today's 6 to 7% rates, their monthly payment could easily double. Even if they want to move, the math doesn't work. This is why rates jumped from 3% to 7%, yet prices barely dropped. The supply structure is completely distorted. Higher rates paradoxically reduce inventory because fewer people want to give up their cheap mortgages. And here's what makes it even more challenging. Millennials and Gen Z are hitting peak home buying age, their 30s and early 40s. This generation is massive, even larger than baby boomers. As they enter their prime buying years, demand surges precisely when supply can't keep up. Now, California's situation adds extra layers of complexity. California's housing inventory is expected to increase nearly 10% in 2026, which sounds positive. But here's the catch. Only 18% of California households can afford the median-priced home at $905,000. So yes, more inventory, but it's still unaffordable for 82% of residents. California also has Proposition 19 creating unexpected market dynamics. Passed in 2020, Prop 19 changed property tax inheritance rules dramatically. Previously, you could inherit your parents' low property tax assessment. Now, unless you move into that inherited home as your primary residence, the property gets reassessed at current market value. Real example, a Sunnyvale family inherited a home with annual property taxes of $1,300. After reassessment, taxes jumped to $18,000 per year. Many adult children simply cannot afford this increase and are forced to sell. The 5 counties where median home values exceed $1 million, Santa Clara, San Mateo, Marin, San Francisco, and parts of Alameda, are seeing the biggest Prop 19 impact. This is quietly creating more inventory in expensive areas, which could create buying opportunities if you know where to look. There's also California's insurance crisis accelerating faster than anyone predicted. Major carriers like State Farm, Allstate, and Farmers have pulled back significantly. I've seen clients whose annual insurance doubled from $3,000 to $6,000. In fire risk zones, some properties are becoming uninsurable at any price. This isn't just about wildfires. Coastal properties in Malibu, Pacifica, and Half Moon Bay face similar issues due to erosion and flood risk. When insurance adds $500 to $800 monthly to housing costs, it fundamentally changes affordability calculations. California's population dynamics are also unique. We lost about 500,000 people from 2020 to 2022, though this has stabilized to nearly zero net migration in 2023 to 2024. But we're not gaining the young, ambitious workers anymore. We're keeping retirees and gaining lower-income residents seeking California's social benefits. Texas and Florida aren't just cheaper, they're gaining the exact demographic California is losing: college-educated workers aged 25 to 40 with growing families. These are prime home buyers, and they're leaving. So when institutions talk about supply shortage driving prices, they're right nationally. But California's story includes Prop 19 forced sales, insurance crisis impacts, and demographic shifts that create a far more nuanced picture than simple supply and demand. Let me show you where institutional money, the smart money, is actually flowing, and why California isn't getting the same attention as other states. Blackstone's recent investor letters show over 40% of their capital going into industrial logistics, data centers, and multifamily housing. They're not making random bets. They're following population migration patterns, housing shortage areas, and stable rental markets with strong cash flow. The cities getting the most institutional attention: Austin, Dallas, Houston in Texas, Phoenix and Tucson in Arizona, Atlanta, Charlotte, Nashville in the Southeast, Orlando and Tampa in Florida. What do these have in common? They're the fastest growing metros in America. Austin recently saw price corrections of 5 to 8% from peak, but institutions view this as a buying opportunity, not a red flag. Why? The city added over 150,000 residents in 3 years. Tesla, Oracle, and hundreds of tech companies relocated headquarters there. The long-term fundamentals remain incredibly strong despite short-term price adjustments. Dallas-Fort Worth is adding 100,000 plus people annually. Corporate relocations continue steadily. Unlike California's expensive markets, Texas offers affordability, no state income tax, and business-friendly policies that keep companies and workers flowing in. Phoenix faced overbuilding concerns in 2024, with inventory up significantly. But the long-term thesis remains solid. It's still one of the fastest-growing metros. Semiconductor manufacturing facilities, data centers, and remote workers continue driving demand. Short-term oversupply will get absorbed. Florida markets, especially Orlando and Tampa, show consistently strong rental growth. Orlando's population growth rate consistently ranks in the top 5 nationally. Rental rates have been rising 5 to 7% annually, making these markets attractive for cash flow-focused investors. Now let's contrast this with California. Institutional investors aren't abandoning California completely, but they're being highly selective. They're interested in specific multifamily properties in strong neighborhoods, but they're not making broad bullish bets on California growth the way they are in Texas or Florida. Why? Several factors. First, California's rental yield is typically 3 to 4% compared to 6 to 8% in Texas and Florida markets. For institutions seeking cash flow, the math strongly favors other states. Second, California's regulatory environment creates uncertainty. Rent control laws like AB 1482 limit annual increases to 5% plus inflation. While this creates stability and predictability, which institutions do appreciate, it also caps upside potential compared to markets without rent control. Third, California's population isn't growing the way Sun Belt states are. California experienced population decline in 2020 to 2022, and while it stabilized, we're not seeing the robust inflow that supports aggressive price appreciation. However, California does have advantages institutions recognize. International buyers, particularly from Asia, continue viewing California real estate as a safe haven investment. Political stability, strong property rights, established legal systems, and prestigious universities make California attractive despite high prices. Markets like San Diego, parts of Los Angeles, and Orange County maintain strong international buyer interest. These buyers often pay cash or make large down payments, caring less about mortgage rates. This creates a floor under prices in premium coastal areas that doesn't exist in other states. Sacramento is an interesting case where institutions are showing renewed interest. It's California's capital with recession-proof state government jobs. UC Davis expansion and tech company satellite offices are diversifying the economy. Most importantly, prices are reasonable by California standards, median around $485,000 versus $905,000 statewide. Institutional investors see Sacramento as offering California exposure without Bay Area prices. Rental yields are better, typically 5 to 6%. The market is less volatile than coastal cities. For institutions wanting California presence, Sacramento increasingly makes sense. The Inland Empire presents mixed signals. Residential overbuilding is real in cities like Victorville and Hemet, but logistics and warehouse markets remain strong. Amazon, Walmart, Target, and other major retailers continue expanding distribution centers. Properties near these employment hubs attract worker housing demand. What institutions are definitely avoiding? San Francisco and much of the Bay Area. Office vacancy rates over 30% downtown, tech industry uncertainty, work-from-home permanence, and deteriorating urban core make this a wait-and-see market. Even at lower prices, the risk-reward doesn't attract institutional capital right now. They're also avoiding high-fire risk areas where insurance is becoming prohibitively expensive or unavailable. Mountain communities and certain rural areas face fundamental insurability challenges that make them uninvestable for institutions with fiduciary responsibilities. The takeaway: institutional money votes with billions of dollars, not optimistic predictions. They're betting on population growth markets with job diversity, affordability, and strong cash flow. California still attracts capital, but it's selective, focused on specific asset types and locations rather than broad market enthusiasm. Now let's get specific about California markets for 2026. Where are the real opportunities, and where should you absolutely avoid? I'm going to give you my professional assessment based on current data, institutional activity, and what I'm seeing on the ground with actual clients. Opportunity market number 1, Sacramento metro area. Sacramento keeps getting dismissed as just the affordable Bay Area alternative, but that misses the bigger picture. Sacramento's median home price is around $485,000, significantly below the statewide median of $905,000. But affordability alone doesn't make it an opportunity, fundamentals do. State government employment provides recession-proof income stability. UC Davis continues expanding research facilities and enrollment. Intel, Apple, and other tech companies are establishing or growing satellite offices. The economic base is diversifying beyond just government jobs. More importantly for investors, rental yields in Sacramento run 5 to 6% compared to 3 to 4% in the Bay Area. I have clients specifically buying single-family rentals here for cash flow, not just appreciation. The tenant pool is stable: government workers, university employees, healthcare professionals. Cities within Sacramento Metro to watch. Elk Grove has excellent schools and family-friendly demographics. Folsom and Roseville offer newer housing stock and strong job markets. These aren't flashy markets, but they're fundamentally sound. If mortgage rates drop to 5.5 to 6% as predicted, Sacramento could see 3 to 5% price appreciation in 2026, outperforming the statewide average. This isn't speculation. It's based on improving affordability metrics as rates decline while fundamentals remain strong. Opportunity market number 2, San Diego East County. Everyone knows San Diego is expensive. The median home price hovers around $900,000. But East County, areas like El Cajon, Santee, and Lakeside, offers homes in the $600,000 to $700,000 range with completely different investment dynamics. Why San Diego broadly remains resilient: military employment is recession-proof, biotech and life sciences continue growing, and international buyers provide price support. Chinese, Mexican, and Canadian buyers still view San Diego as prime real estate. Many are cash buyers unaffected by mortgage rate fluctuations. Coastal properties in La Jolla, Del Mar, and Coronado will remain strong regardless of broader market trends. But East County offers better cash flow opportunities. These aren't trophy properties, but they're practical for investors seeking stability and rental income. The tenant pool includes military families, healthcare workers, and service industry employees. Vacancy rates remain low. While appreciation might be modest, the combination of stable rents and reasonable purchase prices creates solid risk-adjusted returns. Opportunity market number 3, selective Inland Empire industrial corridors. Yes, the Inland Empire has residential overbuilding problems. Cities like Victorville and Hemet have excess inventory. But institutions know something retail investors often miss. The logistics and warehouse boom continues unabated. Amazon, Walmart, Target, and major e-commerce companies keep expanding distribution centers. These facilities employ thousands of workers who need nearby housing. The key is being selective. Focus on properties within 10 to 15 minutes of major logistics hubs. Rancho Cucamonga and parts of Corona show resilience. These areas have better demographics, superior schools, and aren't oversupplied like outer Inland Empire cities. The employment base is diversifying beyond just warehouses to include healthcare, education, and professional services. For investors, this means buying carefully. Not every Inland Empire property is a good deal. But properties near stable employment with good fundamentals can offer both cash flow and modest appreciation as excess inventory gets absorbed over 2 to 3 years. Avoid market number 1, San Francisco and most Bay Area. This recommendation is controversial, but the data supports it. San Francisco's office vacancy rate exceeds 30% in the downtown core. Companies like Salesforce, Meta, and Google have all reduced their SF footprints. The work-from-home trend hasn't reversed. Most tech companies settled on permanent hybrid models. SF's median home price dropped from $1.5 million peak to around $1.3 million, but that $200,000 decline barely improves affordability. You're still paying $8,000 plus monthly to own in a city with rising crime, declining school quality, and deteriorating downtown conditions. San Jose and peninsula cities like Palo Alto remain expensive, often $2+ million medians, without the same price support they had during the tech boom. Tech layoffs continued through 2024 to 2025. Unless you work for a stable tech giant or in AI specifically, job security is questionable. The real risk, if you buy Bay Area now, you're betting on full recovery to 2021 levels. But what if remote work is permanent? What if tech employment never rebounds? You could hold an expensive property with no appreciation for 5 to 10 years while paying massive carrying costs. Avoid market number 2, high fire risk mountain and rural areas like Tahoe, Big Bear, mountain areas of San Diego and Riverside counties. These were hot during COVID as vacation home demand surged. But the insurance crisis has fundamentally changed their economics. I've seen properties where annual insurance costs exceed property taxes. One South Lake Tahoe client, property tax $8,000 per year, insurance $12,000 per year. That's $20,000 annually before mortgage, maintenance, utilities, or anything else. Some areas are entering the FAIR Plan, California's insurer of last resort. FAIR Plan coverage is expensive and provides limited protection. If you need to sell, potential buyers see these insurance costs and walk away. Resale becomes extremely difficult. Coastal areas aren't immune either. Malibu, Pacifica, Half Moon Bay face insurance challenges due to erosion and flood risk. When insurance adds $500 to $800 monthly to ownership costs, the investment math collapses. Unless you're buying cash as a personal vacation home and can self-insure the risk, avoid these areas. For investors or primary residence buyers relying on financing, the economics no longer work. Let me give you specific, actionable advice based on your situation in California for 2026. This isn't generic national advice. This is California-focused strategy. If you're a first-time buyer in California, the harsh reality first, only 18% of California households can afford the median-priced home at $905,000. If you're in the 82% who can't, that doesn't mean homeownership is impossible. It means you need a different strategy. Don't wait for a crash that isn't coming. But don't panic buy either. Instead, focus on these approaches. Target more affordable regions, Sacramento, Inland Empire selective areas, or San Diego East County. These offer entry points $200,000 to $400,000 below statewide medians while maintaining reasonable fundamentals. With rates predicted to drop to 6% in 2026 from current 6.6%, your purchasing power will improve modestly. Get pre-approved now so you're ready when rates decline and can act quickly on good opportunities. Consider smaller starter homes or condos. Upgrading later is far easier than never entering the market. Building equity for 5 to 7 years puts you in position to trade up when your income grows. Negotiate aggressively. 2026 will give buyers more power than we've seen in years. With inventory expected to increase nearly 10%, you'll have more choices and less competition. Sellers will need to be realistic about pricing. If you're selling in California, price competitively from day one. The 2021 seller's market is over. Overpricing means your home sits, becomes stale, and eventually sells for less than if you'd priced correctly initially. The market punishes unrealistic sellers now. If you're in areas affected by Prop 19, especially in Santa Clara, San Mateo, Marin, San Francisco, or Alameda counties, understand that more inherited properties are hitting the market. This creates additional inventory pressure in expensive areas. Timing matters significantly. If you're in softening markets like SF or fire risk areas, consider selling in early 2026 before more inventory arrives. Every month of delay could mean facing more competition. Highlight any insurance advantages. If you have a newer roof, fire-resistant materials, updated electrical, or good claims history, emphasize these. Insurance costs are a major buyer concern. Properties with lower insurance costs have competitive advantages. Be prepared to offer buyer credits or concessions. You might need to cover some closing costs, offer a rate buy-down, or include appliances. Flexibility will be more important than holding firm on price. If you're an investor, be brutally honest about California's investment math. With typical rental yields of 3 to 4% compared to 6 to 8% in Texas and Florida markets, out-of-state investing often makes more financial sense for cash flow. However, if you're committed to California investing, focus on these strategies. Target B-plus properties in stable rental markets, not luxury, not distressed, but solid middle-market homes that families want to rent long-term. Sacramento and San Diego East County offer the best risk-adjusted returns within California. Understand that California investing is often about stability and modest appreciation rather than explosive cash flow. International buyer support and limited new construction in desirable areas provide downside protection. California's rent control laws, AB 1482, limit annual increases to 5% plus inflation. While this caps upside, it also creates predictable income streams that some investors value. Avoid SF/Bay Area unless you're buying severely discounted properties with a 20-plus year time horizon. The recovery timeline is too uncertain for typical investment holding periods. If you're sitting on cash, uncertain what to do, here's my honest advice: don't let perfect be the enemy of good. Yes, rates might drop more in 2027. Yes, prices might soften slightly more in select markets. But waiting indefinitely has costs too. If you find a property that works for your life, good location, reasonable price relative to comparable sales, manageable monthly payment, don't overthink it. Real estate is fundamentally a long-term investment. Whether you buy when rates are 6% versus 5.5%, or at 2025 prices versus 2026 prices, matters far less than buying the right property in the right location if you're planning to stay 7-10 plus years. Transaction costs alone, roughly 8 to 10% of purchase price when you include buying and selling costs, mean you need several years of appreciation just to break even on a flip. This reinforces why location and long-term suitability matter more than perfect timing. Consider this: California lost 500,000 people from 2020 to 2022 but has stabilized. We're not in free fall, but we're not booming either. This suggests a grinding market where patient, strategic buyers can find opportunities while impulsive buyers or sellers get punished. Final thoughts for 2026: this won't be an exciting year. No crash, no boom, just slow, steady movement. California's prediction of 2% sales growth and 3.6% price appreciation to $905,000 reflects this reality. Winners will be people who act strategically rather than emotionally. That means first-time buyers who target affordable regions and negotiate hard sellers who price realistically and highlight property advantages. Investors who focus on fundamentals over speculation, cash buyers who can move quickly on good opportunities. The American housing market has fundamentally changed. It's no longer primarily a middle-class wealth-building tool. It's increasingly becoming an asset class for the wealthy and institutional investors. That's not opinion, that's what the data clearly shows. But California still offers pathways to homeownership and investment success. You just need to be more strategic, more selective, and more realistic about what 2026 will actually deliver versus what you might hope for. Subscribe for weekly California real estate insights. And if this helped you understand California's unique market dynamics, please share it with anyone buying, selling, or investing here in 2026.